tonight's all about boosting your capacity despite the growing interest rates with my very good friend Matt Punter from TSC Mortgage Brokers, who's going to be speaking to you about that exact topic. One of three reasons, or all three of these reasons, the nervousness that's been happening in the marketplace around the interest rates. So how's that going to affect you? There's been a lot of talk around the rising interest rates, and when you stay informed as to how that might affect you, would be reason one. And then you've got your eyes on potential investments and want to be sure you're making a savvy decision, could be reason two. And a lot of people have given us feedback that they want to know, how does it increase the rates that affect you and their ability to finance commercial deals, and what you can do about it. So Matt's here to answer a couple of those questions. So just a little bit about myself. I've been trading in real estate since the age of 22. So it's a good 35 plus years. I'm showing my wrinkles, yeah. I bought my first investment property, turned that property around and bought it for $360,000 and sold that property off a couple of years later for $1.3 million. And I went on during that time to be purchasing property, turning them around and reevaluating them and drawing tremendous equity out of those properties to do it again and again and again. While I was busy doing this, I founded a manufacturing company called ProAd in 1999. We manufactured to multi-million-dollar companies like Reebok, Adidas, Puma, Caltex National, and I used to work under contracts for these companies while I was busy building up my real estate portfolio on the side. So I was learning real estate, doing real estate while we were doing manufacturing. We hit a little bit of a rough patch in South Africa, which hasn't really stopped. And a couple of years on, probably about 10 years ago, was actually it's more like 15 years ago, I was attacked. I landed up in a wheelchair. I survived that. It took me about 3 years to learn how to walk again. And then my factory was burnt down, and it was kind of like the writing was on the wall. I was being invited to move over to Australia, and I thought it's a no-brainer. I wanted to get out of the war. So I moved over to Australia. However, it came with a bitter pill. And when I moved here, I could only bring with me 8% of my wealth. So when I started in Australia, I started from ground zero. I had to sell my company in South Africa, sell all my assets in South Africa to move here. It took me 6 years to get the funds over, and that was only 8%, and start all over again. However, I had accumulated over 32 properties in South Africa, and I knew how to do this. It was in my DNA, and I thought, well, the only thing to do is to start doing it again. So that's exactly what I did in Australia. I started building my portfolio, and to date, I have secured over $81 million in acquisitions for both my clients. We've won a multitude of awards. I launched Mish Commercial about 5 years ago, and we rebranded that to Revolve Commercial, and very happily, very successful at doing what we're doing right now. That's a little bit about me, and I'd like to introduce you to Matt Punter. So Matt, you are the CEO and owner of a growing residential and commercial finance business. Can you talk briefly on your journey and why finance?
The journey started with banking career. So I fell into banking more out of accident than by design. And I joined a small regional bank, Bank of Queensland, up in Brisbane. And from there, I learnt, I guess, the craft of banking, and then went into lending. I left that and started up a mortgage broking business after many years of studying on the side, nighttime study at university and at TAFE College. So I really just enjoyed finance. I really enjoyed helping people. So that was that was the draw to finance. I saw that finance was the common connector. Everyone needed finance, whether they were expanding or if they were in trouble. in the good and the bad of it, people still need money. So I thought if I can learn about how the money flows around, I can try to work out how to help people move forward in life, either out of a problem or into an opportunity.
I know you refer to yourself as a reformed banker. Can you explain what this means, please, and address the natural question people may be asking themselves is, should I be using a banker or a broker?
Yes. Yeah, I get this a lot, actually, Mish. A reform banker. So I enjoyed banking. I really did. I enjoyed being able to help people. The frustration that came with it was that I only had one suite of offerings. So I had one credit policy that the bank would adjust based on lots of different factors, but and factors probably that I didn't really understand at the time. So for me, it was just I would see a good customer with a what I believe was a great ability to repay the loan. And unfortunately, because it didn't meet the bank's credit policy at that time, it was a no. So I had to deliver that bad news to many clients. And that just, it probably lit a little fire in me as to how do I go and help more people to give them yeses. And I had a client, it was back in early, it would have been late 90s actually. A client that would come in, I just knew him as a client, but he was actually a mortgage broker. And we would pay him a fee to help our clients that we couldn't help. And I thought, well, this is a wonderful vocation. I need to investigate more about that. So I call myself a reformed banker because whilst I really enjoyed the journey, I just couldn't deliver what I knew. I knew there were solutions out there and I didn't have them. So I built the rapport with the client. I got their trust, but I just couldn't deliver a solution. So I call myself a refined banker. And the second part is just for the audience is to answer the question, do you go and see a banker who you've been banking with? You know, Commonwealth Bank probably seems to be the most popular bank that we come up against, or we use them a lot ourselves. But people say, I banked with Commonwealth for 30 years and they know me, so I'm going to go with them. And that's a fine rationale. When I look at what we can offer as opposed to what I could offer as a banker, and I've spoken to and now employ a few, more than a few actually, ex-bankers, and we all have a bit of a chuckle about it over a beer on a Friday, just about how we can give a lot more yeses now because we know a lot more about finance because we're all reformed bankers, basically.
And it's so funny that you say that because I get that all the time. Constantly, we're having people that are coming in and saying, no, they've already got a relationship, they've already got their broker or their bank or whatever. And I always say, yeah, that's fine. You know, I'm not going to stop you in doing that, but I would like to introduce you to our professionals, and then I explain to them the process of what the advantages are dealing of going shopping across a multitude of products as opposed to just having one product, being stuck with one. So I can really resonate with you in terms of helping them to get over the line and making sure that they're going to achieve the best result at the end of the day.
Yeah, and I think there are more options than ever. And this is my second mortgage broking and finance broking business. So I had one for many years and then jumped into the legal area for many years and developed another product in there. But I've seen it change. And I think I was out of broking for probably 6 or 7 years there. And the change that I saw when I came back into the market and ever since, this business has been running for about 8 years now. And just the change, the number of new lenders, the digital options that are around as well, the innovations that are happening in banking, it allows them to assess every commercial proposal basically that comes through faster. Some of the bigger banks are lagging in that regard, and they're, as I understand it, they're spending a lot of money now to try and play catch up because they have to turn around the Titanic. Basically, it's a big beast and there's a big legacy there. But some of these innovative lenders that are coming in, they're just so fast. They're swift. They're looking at cash flow. They're looking at the commerciality of the transaction and saying, how can we get comfortable with it and what can we do to satisfy ourselves that if something doesn't go right, that we've got a reasonable security position. So it's a really interesting time. We learn. I learn. We've got a team of 17 in our Sunshine Coast office, and we just continue to learn about what's out there, what you can do, things that we didn't know. One of the chaps is an ex-ANZ banker of 30 odd years, and he said to me the other day, he's 67. He said to me the other day, God, I would never thought that you could write that loan, that anyone would write that loan. So yeah, we're always learning.
It really is unbelievable what we're seeing. And I mean, and everybody's asking the same question. Everybody wants to know what is happening to the interest rate at the moment.
A couple of things. Obviously, we've seen 6 rate rises, majority of them being big, chunky 0.5 rate rises, and that's been a huge shock to everyone. It's been a shock because all of our repayments have gone up. We deal in a number of different things, and I keep getting these letters like I'm pretty sure all of your listeners are as well, saying your rates have gone up. We're passing that on straight away, as banks love to do. They don't like to pass on the reductions straight away. They keep them up their sleeve for a little bit. But where we see it is they've started to slow it. And I think that's a really good thing, because there's a lot of talk now, particularly in the media, which can be really helpful sometimes, around just it's slowing up. Global recessions on the horizon, with things happening in the US around their midterms. The UK's got some interesting things happening with their policies at the moment, with their new Prime Minister and Treasurer. So I think what we're seeing is a little bit of trepidation from the RBA. They've reduced the latest increase was 0.25, so they've steadied up a little bit. There's talk that we'll probably get another 0.25 next month, and then they may sit through December and just see what the numbers come back at. Inflation numbers, CPI, and unemployment's another one they're looking at as well. So there's some key indicators there that will help them to make good decisions. As far as competition's concerned, which is probably more relative to all of us that are in property right now, is that there's a huge amount of competition out there, and this is where if we can let go of our, we call it the BLT, the bank loyalty tax. We all know that we pay a premium if we stay loyal to a bank, because it just slips its way up. And there's a lot of discussion around this in a lot of the finance books around how it's called margin creep. So they get you in on a nice honeymoon rate, or it's a great rate at the time, and then their rates move up for what they call their back book. So if you have a loan on, let's say Bank of Queensland, they're my old stomping ground, and they're really good at this. They'll put out an amazing special. They'll hook in lots of business at a really cheap rate, and then 3 to 4 months later, we'll see their rates go up outside of RBA rate increases. So they're just pumping up the tyres a little bit on the vehicle. It makes it go a bit faster and it's a bit more profitable. So that happens just organically with every lender. Bank of Queensland are one that we've just seen have done it a few times over the years where we've really noticed it, that they're particularly good with it. So I think the key messages there, takeaways, are probably that competition can save you a lot, and therefore with the diminishing profitability that, we had an amazing time for a period there for a couple of years whilst they were in the cash rate was at 0.1 or thereabouts. We've all made good commercial outcomes as a result of that, but now we have to think a bit more. So I think now's the time to let go of bank loyalty and just have a look at what the options are, because at least if you know what the options are, we all know what the options are, we can make a good commercial decision around where we finance our properties.
So you're suggesting shop around.
Very much so. Find someone that you're comfortable with.
Yep.
That's in the broking space. Great if you can sit down with someone. If not, get on a Zoom call. But just find someone you're comfortable with, that you trust, and give them some information. Arm them, which is basically just putting the bullets in the gun. So give them some information about what you've got, what your income looks like, what your rental lease looks like, particularly with commercial property. The strength of your lease is a really powerful tool for us to use to be able to shop what you've got around. The other thing we've seen a massive change in, if people haven't done a revaluation recently, is that everyone seems to have a lot more equity. So with more equity and the loan amount, the gap widens, which is it reduces your LVR, it decreases the bank's or the lender's risk, and therefore they're happy to decrease it. So we generally start with what we call a repricing request with the existing lender. So if anyone out there has loans at the current time and they haven't approached their lender to say, please reduce my rates, I would suggest have a chat to someone, get someone to put it together, get a valuation first, and demonstrate that your LVR is so much stronger, therefore their risk is so much less. That's going to give you the biggest potential for a decrease at your existing lender. And then I'd also say shop it around, because there's some amazing cashback deals at the moment. Banks are really, because there's less volume in the market and there's more lenders than ever, they're really, really competitive. I've never seen anything like it.
Yeah, I must say I've been seeing unbelievable LVRs coming through on commercial as well. Matt, just as a matter of interest, now I've got my own views on this, but I'd love to know what your views are. With regards interest rates, what do you think is driving the interest rates at the moment, financially, internationally, economically, politically? What are your views in a nutshell? What do you think's driving it?
I think there's a lot of factors coming into play. The biggest one, obviously, is they're just trying to tame inflation. That's the biggest thing at the moment.
They're playing catch up.
Yeah, that's right. Look, I think I read a lot about how the RBA governor, he was attacked there for about 6 weeks ago. I remember him, just the media were getting stuck into him, and he said, look, we were making the best decisions that we had with the information to hand, but I just think there's a lot of things that have unraveled a little in the world with the, Russia, Ukraine being primary. You've got political conflict, I guess you call it, with the Trump Biden. You've got the midterms happening in the US. I think that plays a massive role in confidence. I think confidence is the hugest thing. So if I was to nail down one point, it's all about confidence, with an underlining inflation and underlining below that world uncertainty.
I must say, I definitely see this. It's a very balanced. It's a very delicate balancing act. The inflation and the international exposure that we have, and realistically, we are the US's baby cousin. So whatever's happening in the US has got a direct knock-on effect of what's happening with us out here. So the big question, Matt, is how do we navigate around this issue to ensure that we're making the best investments?
Yeah, so look, I think there's a world of opportunity out there now. Competition is always a good thing. So it if nothing else, it keeps your existing lender competitive. So they rely on us being a little bit busy, call it that. Once we've got I'm as guilty of this as anybody. You get busy doing, banging my nails in, and I forget about I could save money. So I kind of look for, what's the most dollar productive exercise you can do this week? What is it that I can do to influence the profitability? And I really look at my property portfolio as a business. I don't view it as I've just got that sitting on the side. It's I've got a finance business. I've got 2 finance businesses, and I've got a property business that I run, and I treat them very much like a business, and I invest time and I allocate time for each one of those businesses. So I guess my advice to people would be, if they're interested in growing their portfolio, if they're interested in paying off their debt sooner, it really does pay to have a look at what you've got, have a look at what your equity position is. I think that's some lenders will force you to get a valuation done. Some lenders are paying for it at the moment, so we can get valuations done. This is part of the offering, and the competitive offering that's out there is that lenders are offering to pay legals, pay valuations. So it's kind of why wouldn't you?
That's super competitive. I don't think we've seen that for many years. I mean, when last did you see lenders paying for valuations and legals? Quite a long time ago.
It leads into, we're seeing a lot more self-managed super fund stuff as well in the commercial space. So people are looking at their dismal returns, over some time, looking at it going, okay, well, what are the other options out there? So there's despite the fact the majors mainly have dropped out of that SMSF market, all of these new lenders are coming in that are happy to put people in front of people. The bigger banks want to automate everything, so if they can't automate it, they seem to be moving out of that space. And SMSF is just one example of that. But yeah, there's some really good lenders that are well capitalised and are running into that space. So there's options there for people if they want to grow their portfolio. Maybe sometimes a little look sideways is a great way to go, to say, well, okay, if you're tapped out on borrowing capacity in your non-super space, have a look in the super space. It may be something that you can do something with in there if it's comfortable for you.
And Matt, how competitive are these new lenders that are coming in? Because I mean, I know the superpowers in banking they've got the muscle to, to really drive a sharp deal. So with the new lenders coming in, how sharp are you finding their deals? How competitive are they?
Yeah, pretty well. The biggest difference between the majors and the non-bank lenders is there's a lot of infrastructure. So they have to spend a lot of money on marketing, the big banks. They have to spend on property. So they have to either own property or lease property. And then they've got many, many mouths to feed, staff. And then they've got their systems that they need to reinvest back into heavily at the moment because they're really lagging, some of the newer guys. So the smaller guys that we're seeing come into the market, and some of these guys, when I say smaller, ING is a great example of this. They came into the market. They're a European heavyweight, but we didn't know about them until maybe 18 years ago or so. And they're extremely well capitalised. Now they've come in through the savings accounts, so they've innovatively come in and said, "Hey, we're the orange bank with the lion, and put your money with us, and we'll give you the best return." So they've got this funding base of Australian savings. It's quite incredible. So when I say they're not well known to us, some of them are really big, really strong lenders who they've actually got the ability to go pretty sharp, and we just offer it. So our role as an intermediary or broker in their transaction is just to see. Our job is to go and do that legwork for people and just bring back some options as hey, we found this over here and this over here, and this one will let you go to a higher LVR. Some of them will let you take cash out. So if you want to grow your portfolio, you can grab some out of this one and buy another one, or it might be that you may want to manufacture some growth in your portfolio or in one of your properties. So we see people putting mezzanine levels into man sheds. Man sheds are the new cool thing on the block at the moment. Place for the boat and other bits and bobs. But I've seen one recently, a really good deal where a chap borrowed 150, put a mezzanine level, got him an extra 86 square metres, and that increased his rent massively, which increased his valuation, which let us pull the money back out of that property. So it was a really good play that we just worked out that we could help him do what he wanted to do, increase it, but we manufactured growth on it.
And it's a great strategy. I mean, to be doing that kind of stuff, and that's the beauty about commercial, is that you have a multitude of strategies that you can adopt to add that value and to do revaluations, to pull out a ton of equity and go and do it again. I mean, again, I talk about that all the time. That's one of the loves for commercial, to be able to do that.
Yeah. It is wonderful. It's so good to make that happen. So we just know there's lots of lending appetite out there. If you're interested to explore it, have a chat to Mish. Feel free to have a chat to us. I'm happy to help wherever we can. But there's definitely options out there that people can explore if you want to.
And lots of them. Matt, just to help out our listeners, can you explain the key criteria to ensure that our listeners are ticking all the right boxes? Now, this is really, really important when applying for those loans. What are the key criteria that they should be taking note of? So
the three main criteria they look at. One is credit. So they'll we do a credit check on all of our clients straight away, just so we know what are we playing with, what entities do we have, what directorships. It also gives us a score. And the other thing the credit report gives us these days that it didn't used to, it gives us any live facilities. So any lending credit facility that's live at the moment, probably 95% of them anyway, will show up on your credit report. So we can have a look at 24 months of conduct on every live facility that you have, that if you're in your personal name or if you're a director of. So it's a pretty powerful tool. We have a look at that straight away, and we just make sure that there's nothing there that we don't know about. So that's if your listeners have not had a look at their credit report, you can get a free one. It takes about a week or so to come to you, but you can go on to, if you just Google Equifax, there's a couple of other ones, but Equifax is the main platform that the lenders are using now to have a look at people's credit. So I'd suggest have a look at your own credit. If you can't, feel free to contact us, and I'm happy to get a credit report sorted out for you. The second set's credit. Once we tick that box, we move on to equity, and we understand what the bank's proposed equity position is based on what the valuation is, and then we roll that with the loan amount or the proposed loan amount. So most lenders will let you go to up to a maximum of 80%. Now, there are some exceptions to that where we've got medicos and other professions, accountancy, some legal as well. There's some lenders that are like legal. They'll let you go a little bit higher. So they'll let you borrow sometimes up to 100% and more. There's a couple of little asterisks with that, but just know there are options if you don't have equity, but you are interested in getting into the commercial property world. There are certainly options there depending on what your profession is, and feel free to have a chat. So we've got credit report, we've got equity, and the next one is your borrowing capacity. So borrowing capacity is probably the area that we spend most of our time on. It's a minefield of opportunity. And if you get it wrong at the wrong lender at the wrong time, you can decrease your credit score. So every time we put a credit application in, there's a number of points. Generally, we think it's 30 to 40 points. They won't ever give us the algorithm, but that's anecdotal from lots and lots of applications that we've made over the years. So you don't want to be going and making too many applications. You really want to do the research first, pick one lender, and we generally don't submit a loan unless we know reasonably well that it's going to go through, so that we know that security property is able to be taken by that particular lender. They like the location, they agree with the LVR, so we've got agreement on that location, that type of property, that's a max LVR. And generally, that'll be 75%, but we do have lenders that will go to 80%. And then we do have lenders that will go to 30-year terms as well. So it just stretches out that cash flow a little bit. But they're the three key criteria that we're looking at. We've loaded some financing mistakes to avoid there as well. We talk about the BLT, the bank loyalty tax. Sometimes the best rate is a false economy, because they can catch you up later, and they may impose 15-year terms on you rather than 13-year terms. So that can squeeze your cash flow. That can also impede your borrowing capacity. They also may put an amortization clause in there where you get 5 years interest only, and then you've got to start paying down the principal. So just know there's so many different policies that chasing the best rate is not always the most suitable product. And again, we address that on a case-by-case basis, just by highlighting what some of the opportunities are, particularly where people are looking to grow their portfolios and or improve their current portfolios. One of the other points I put there was not thinking ahead of the current transaction. So we see a lot of people that solve their immediate issue just by going back to their banker, but then another opportunity comes up, often in the same geographical area and or of the same type of property. So if it's industrial, sheds or whatever it might be, but they'll find another one that meets their same criteria because they've already done all the homework. So we just say, look, have a think about what ideally you would do, or if you could do it. And then we start to work backwards and reverse engineer it. So improving borrowing capacity is probably, as I said, where we spend the most of our time. We like to spread lending across lenders. So I've personally got about 5 different lenders that I use for my portfolio. And I don't like to give them too much purchase on anything, because they can not like something that's happening in a particular area. I had a commercial property up in Cairns. It was just a retail shop front that we used in the law firm we had many years ago. And I kept that one for a number of years, but the tenants stopped paying. So we had to roll with that. Unfortunately, that did impact some of our residential stuff that we had because we were with the same lender. So there's just some learnings that we've had over the years around spreading your lending out to make sure that your lender doesn't have too much control over what you can do inside your portfolio.
And that's always, we always talk about cross-collateralization. If you can avoid it, then avoid it at all costs, as Matt's just indicated. I mean, if one bean falls off the cart, it affects all the others, basically.
There's some clever ways still to get access to that equity without cross-collateralizing it. So that's important that people know that it doesn't take that solution out of play. You've got equity in a property, that's great. We just got to work out how we get it out and then place the next deal somewhere else.
So what would you say, in your opinion, what would be the best way for our listeners to, in relation to improving their borrowing capacity, what would you recommend? A couple of key notes, what to do. A couple of lenders that I've spoken to in the past have said, if you've got any credit cards, just pay your credit cards off and cancel them while you're busy doing your loans. I mean, that's that reflects on your credit rating, and it's a silly little thing that most of us don't even think about, but actually it's one of the things that does impact on your loans.
Just little things where if you know what you've got access to and you know what you've got. So sometimes you just forget, like you've had a credit card for years. That's a great example. That's the most common one we find. The other one is debt consolidation. That's a really big one. And this is particularly for self-employed people where I might buy my office and then I have some leases for cars and then I have some equipment. Now, if that's all wrapped under, and there's horses for courses here, so I put a big caveat over this one, but it's one that we see a lot. The individual cost of each one of those adds up to a really large number. So that impacts your monthly cash flow. When we're assessing borrowing capacity, particularly, we have to look at what income do you have coming in against what expenses do you have? And the bank always wants a little buffer. So where you've got 5 debts, for example, that are all, one might be 5 years, one might be 3 years, one might be 15 years, another one might be 30 years. If we can get that all under one umbrella and spread it out as much as possible, we just make an instant improvement to your borrowing capacity. It's just incredible. So debt consolidation would be, after doing a credit report, to work out, okay, what still resides on your credit report? Because often they get it wrong too. We've found countless errors that loans just they're not there anymore. It's gone. So we go, okay, well, let's take that out, get it removed. And then we start to look at, okay, what's the lender going to look at now and how are they going to view what they see? So we just make sure that we know what they know. And then we start to strategize and go, okay, let's have a look at consolidating some debt and bringing it under one loan amount and stretching that right out. So that can make a massive difference. Other things that I popped in there are rate reductions. So if you've got an existing rate, let's just trim it right up. And if they won't trim it up enough with what's competitive in the market, then we refinance it and take it somewhere else. You probably find yourself with a cash back, So not only will you save money, but you'll actually have money back in your pocket that, you can go and buy those new golf clubs or take a weekend away, but there's a lot of competition. The other thing I put there is just reducing your monthly living expenses. Sometimes, this doesn't always happen in the commercial world, just depends on how the structure looks. But if there's lots of different lending things that they're looking at and they want to assess that, particularly the majors, they're the most scrutinising in how they go about assessments. And this is why sometimes we look to use non-bank lenders that are a bit more lateral, a bit more flexible, because they won't go through. They're looking for reasons to write a deal, not looking for reasons why we can't write a deal. So it just depends on where they're at in their cycle of book balancing.
Yeah, that makes a very big difference. What is your experience, your philosophy around the importance of compounding, building wealth?
For some time, I was building a portfolio and I was looking at the growth that I'd had across, just doing an analysis, taking a business view and saying, okay, how's my property portfolio performing? And look, I had some commercial, I was heavily residential, and I split some into super and some not in super. So I had a bit of a mixture of different types of properties in the portfolio. And for me, I just worked out it wasn't performing as well as I'd hope it would. I'm in my mid to late 40s and I thought, okay, I'm still feeling pretty aggressive about wanting to grow it. But I didn't want to grow it in a just a simple buy and hold way. I decided to go in for a compounding equation. So I was lucky enough to have a friend who's built a really large business by reinvesting everything back in. And then I've taken that philosophy and worked the same way. So I did I jumped onto the ASIC Money Smart website. And I just worked around with their compound calculator. And it's amazing that even at a 10% yield, you can double your money in 7.4 years. So on that principle, I thought, well, we move into projects now. We manufacture growth with or without other clients / joint venture partners. And we look to roll the capital that we put in there. So let's say it starts off at $1 million that we put into some properties. And then we get our capital back. We get our profit that might be, say, 400. And then we're rolling 1.4 into the next round, paying some tax at some point as late as we possibly can, but we never miss it. But there are some clever ways there to manage that sort of stuff that you can talk to your accountant about. But the compounding is really just a philosophy for us now. we're looking to, see how quickly we can turn $1 million allocated to a particular part of property, the segment, and how quickly can we turn that into 6 million. And then we're doing that with another sector and another sector. So we're working with some clients as well to do joint ventures where we're actually both got skin in the game. They may run the project and I make all the bill payments. And so we've moved into what we call our JV business, our PJV projects. So it's just a different way that we're looking at, a more aggressive way that we can manufacture growth in residential property, in commercial property. We're looking to balance that out as we grow. So we've got a nice mixture.
What made you move into doing joint ventures? What would you say would be the advantage for people to be doing joint ventures?
Look, it happened a little bit organically for us. We did some work with a number of property investors that are looking to learn. So they're looking for education around property. They're looking for to connect with other people. And in that process of helping lots of different people do their projects over the years, so we've been funding largely property development, small lot development, renovations, manufacturing growth, and commercial. We've been doing that for a long time, and I've just seen people do really, really well when they're more actively in it. And what I realised is that I didn't have the time, and my skill set's not really in property. My skill set's very much in finance. So I did a little SWOT analysis on myself, and I went, okay, this is what you're strong at, and this is what you're not strong at. And then I also looked at what do I like doing? And I love the funding side. I love to come up with solutions, and people throw problems at us, my team and I, and our challenge is to try and solve them and get them a good outcome. So I went, okay, well, I'll just stay in my lane. I'll finance them. So I'll provide the capital and I'll provide the borrowing, and I also control the vehicle. So I kind of liked that. I had some investors come to me and say, what are you investing in and can we invest with you? And I thought, okay, that's interesting. I hadn't thought that before. I didn't know that was something that would give other people comfort, but evidently it's given a lot of people that as we've grown from one project, we've grown to 10. We've got 10 projects down in Canberra now with a particular developer that we really like down there who's doing some clever things. We're learning as we go. So I get to learn about property while staying in my laneway, and we just partner. So we just split the jobs. So I bring the money. He does all the work, so he's got the time and he's clever with finding properties and how to manufacture growth with them. And I'm the one who brings the money. So I talk to lots of people and say, hey, this is what we're doing. We've already got our capital in this deal. If you want to talk to us about that, let us know. And we'll. So it's just grown. It's grown from one deal into now we've got 14. We've got four on the Sunshine Coast where I live, and we're doing a bit of a mixture of different things. And yeah, I've got a few more ideas about how to do some more stuff in the future that I'm excited about. But it just happened organically, but I saw the opportunity because it comes back to treating it like a business. I thought, how can I treat this more like a business and invest time and capital back into that business to try and grow my wealth from that? So yeah, it's been an interesting journey and one that's continuing.
I must say it's an area that I have dabbled in the last couple of years, and I thoroughly enjoy it. And for me, I think it gives me the opportunity to take a lot of people along who wouldn't ordinarily invest in commercial real estate because they're scared of the risk. They don't know how to. They don't have the education. They don't have the knowledge. So we invite them to come along and join us on a couple of joint ventures. And I must say we've got quite a few in the pipeline that are going to be coming up. Very exciting. So I think, Matt, you and I are going to be talking about that.
Yeah.
And taking that out to the network as well. Very exciting.
Definitely a chance to grow. I'm learning a lot about property, and I know I just was doing something this morning, actually working on a deal, and I knew the numbers were not quite right just because it's just repetition. I had some exposure and I went, okay, that doesn't look right. So I went into the spreadsheet and mucked around with it and did a little bit of research and came back with some other numbers that I felt comfortable that FISO was something that I could take to a lender and say, hey, these are the numbers. They're based on these assumptions. Here's my research. This is why we think we should. So we can put a better proposal together. So me learning about property makes me a better lender, to be honest.
Well, that's great. And I think so long as you're learning, you're growing. So we never stop learning. That's what keeps me getting out of bed every single morning. Matt, I want to say thank you very much for your time. I really appreciate this. I know you're a super, super busy guy, and pinning you down has not been easy. So I really appreciate it.
I apologise to Angie for that.
So for anybody out there, if you're trying to get hold of Matt, he's got an absolutely awesome team all the way around him, and Matt's team will be providing a free borrowing capacity discovery session and property portfolio reviews for anybody who mentions Revolve Commercial. So get hold of Matt and his team. And just to blow a little bit of smoke in Matt's direction, they have a 71.3% strike rate of reducing rates and for improvements on your terms. Think cash flow, guys. Cash flow improvements. And just bearing in mind that he's been doing this for a very long time. And these are his strike rates since April this year. So pretty impressive there. If anybody wants to get hold of Matt Punter, reach out to Revolve Commercial. Or Matt, what's the best way to get hold of you?
Yeah, look, my email is there as well, matt@puntersfinance.com.au. I'm happy to, if I miss you, you will get someone from my team come back and just make a time. So, but look, feel free, send me a quick email, just mention that where you've come from, and be really happy to see what we can create and just helping people to continue their property journeys.
We've put a QR code onto the screen where you can book a call with the Revolve Commercial team for a free wealth grow plan. Otherwise, book a chat. And again, that's a free chat. It's about 30 minutes worth of everything about you. So we take you on a little journey to see whether you would qualify for commercial lending. And if not, if you're interested in the joint ventures, anything that we can basically help you with. So the QR codes are on the screen if you want to take a quick screenshot of that. Otherwise, just reach out to revolvecommercial.com.au. All the contact information is on there. So Matt, again, thank you so much for spending this time with us. I really, really appreciate it. I think we could probably speak about this for a good while longer. I know there's a heap more that when you and I get talking, we could talk for hours.
Absolutely.
It's been really great, and hope to have you on again.